We're going to start right away. But before I start with this topic number 5, I will have to warn you. You know, this is advanced level of CPA. Now, whenever you look at, for example, the graduates, if you look at the graduates or graduates list that CASNEB produces, at the end of every time they finish marking, they normally do some booklet. That booklet, you will never ever see more than 2,000 students, in this case, here being allowed to do what, to graduate. All right. So you get, like, for example, last semester's paper was not very, very hard. Actually, most students were able to call me after the exam and they told me, Mwalimu, this is really what here, a doable paper. Not an easy, but it's a doable paper. But again, some of them, a smaller percentage, failed. And they're not really stupid. You can't say that these guys are lazy, that's why they failed. No. Ladies and gentlemen, at that level, of course, CASNEB does whatever they do. So at the end of the day, they have to squeeze those numbers. Out of, say, for example, 10,000 people who are sitting for the paper, then we shall only have like 2,000, because we'll never ever, in this case here, get to see over 2,000 being allowed in that graduates list. All right. So I'm not saying that CASNEB is unfair. No. But the thing is, we must really fight it out for us to be in that coveted list. We must really fight out for us to be in that coveted list. How do we do this? Remember, for the ones who are coming from the lower levels, and of course the students who have been at RCM, the secret is in this thing that I'm seeing you guys really fighting, and you'll have to forgive us. We are working day and night. We've even been able to now increase the people who are adding students into the LMS. This LMS is a game changer. It's called a learning management system. This learning management system, we normally put what here? We normally put videos. And at this advanced level, you'll see we are putting videos and even notes. Videos and notes. And we are putting videos for class, and then number 2, videos for revision. All right? So the students who are very bright, normally what they do, once they get access to the LMS, they will not be waiting for the teacher to come and do introductions. Like now today, I'll be starting by introducing what we call reorganization and reconstruction. This is supposed to be reorganization and restructuring, yes. At times in this case, you're called reconstruction. So you see, I'm going to introduce that. Ideally, if I'd given you like a roadmap, which this semester I'll be able to give you a roadmap, I'll be able to tell you that after this topic, next topic will be this and this and this. I'm going to give you a roadmap. Once I give you that roadmap, I expect you to be my pace setters. Pace setting means what here? You getting ahead of the teacher. Ahead of the teacher. For those of you who do marathon or who have ever watched marathon, you understand what we call the concept of setting the pace setters. You need to be ahead. You need to be ahead. You need to be ahead. You need to be ahead by always using what here? The LMS videos. This semester, this thing is going to be very, very different. This semester, I will be coming here on Fridays, Saturdays, and Sundays. And trust you me, I will not be that type of a lecturer who will be coming to introduce everything. No. This semester, I'm going to handle this more of like a special revision class. And I'm so sure everybody will really be happy that way. So that now, Monday, Tuesday, Wednesday, I'll be telling you before we meet, at the very least, you must have watched this video and this video. At the very least, I'll be giving you how many videos to watch before our Friday, Saturday, and the Sunday classes. 2 videos. You watch them. So when I come here, it will be what here? Somebody, questions, answers, tips, and the tricks of how to pass this paper. Does that sound like a plan? Or is there somebody who would want Mwalimu like to be doing everything here? Does that sound like a plan? Yeah, Teacher David will still be there. Remember, we normally team teach. We normally team teach this paper. He's there. Does that sound like a good plan? Or do you want Mwalimu in this case here to be doing like all the introductions? No. That one has already been overtaken. That one has already been overtaken. Mzembe is saying, yeah, great. Good deal, yes. Mzembe is saying, yes. So, ladies and gentlemen, it will be very important when I give you those 2 videos, and I want to take this opportunity to tell you normally what good students do. Those videos, you can watch them at a speed, at a higher speed. All right. So in this case, you can say, I'm watching this at 1.0. This is a normal speed. Or you can watch these videos at 1.25. Or you watch them at 1.5. Most students who have seen this LMS before, which speed do you normally use? Which speed do you normally use? No, 2 gigas is too high. 2 is too high. 1.5 to me is perfect. 1.5 to me is perfect. 1.5 to me is perfect, yes. Or 1.25, if you're not able to follow these concepts, if you feel that even 1.5 is very high, especially for a new concept, then you shall never use 1. It is the lazy students only who use 1. You know, when I do 1.25, I'm recovering a quarter of the time. When I do 1.5, I'm recovering a whole 50% of the time, like 0.5. All right. So this extra is, I'm able to watch much faster. And then remember videos you can do. Now you see, if a teacher is speaking at 1.5, a class of say 2 hours will take you like 1.5. You're going to save those 30 minutes. That is a game changer. So this LMS, I would want us in this case here to really make use of this LMS. And this time around, we are going to have a chief whip. We are going to have a chief whip. Who is this chief whip? The chief whip in this case here, we have some lady who volunteered. The chief whip will be able to ensure that she guides the other students, in this case on the videos that they're going to be watching. The one who will be in charge of this cohort, her name is Regina. Is Regina with us here today? Is Regina with us here today? Is Regina with us here today? My first time. Julius, I will show you this before I disappear. Julius, I'll show you how to do this before I disappear. Sawa. Deputy Chief Ninja. Now we have the Deputy Chief Ninja, the Deputy Teacher. Is Regina with us here today? I think we'll have even to appoint two deputies here. She's not around. What do you mean, Regina? She's not around. We shall overcome. We shall overcome. We shall overcome. We shall be able to look for a chief whip here, a chief ninja, deputy chief ninja, yes. We shall be able to get somebody who will be able to set the pace now for everybody else. Somebody will be able to go to the LMS, watch a video, which of course the teacher has told you to watch, and then she'll come and report on WhatsApp. I've watched this video. I was not able to understand this, or I understood from this video, I understood this and this, and you will be surprised that thing would really flow very, very smoothly. Last but not least, ladies and gentlemen, I've also observed something. During this, when we come near to the exam, I would want you at the very least to request for a 1-week leave. At the very least, I've observed this. Remember, at the very least, we have what we call the low-hanging fruits. If you remember, we have the low-hanging fruits classes. Like like the AFR. I don't have to understand everything in advanced financial reporting. There are those things I know. If I touch this, I add the 2, for example, I get blah, 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 blah. So that last week, even if you can't get all the days for the last week, a minimum of how many days here to the exam? 3. You must request for some leave days. Is that possible, ladies and gentlemen, from your end? Is that possible? Before 2nd of December, that last week, are you able to squeeze, in this case here, something there? Because I've always seen a correlation between students who go for that leave and the passing. There is some time back, someone told me that Mwalimu, during that week, then I will have to feign sickness. No, you know, it's about proper planning. Like now you can start planning with your boss. Today, when you go, in this case here, for example, to work on Monday, start planning with your boss. Ladies and gentlemen, there is a joke that somebody made in the RSM family. And of course, people laughed. But you see, myself, I like reflecting quite a lot. That like now this semester is very short. That this is the semester that men who are around here must drop all their girlfriends. Is that fair? Of course not. Not fair. Not fair. I mean, what that gentleman was talking about, and I saw so many guys in this case are trying to hit on him. They thought that guy is very foolish. He was talking about what your time management. Some of you in this case here work, for example, on Saturday up to 1 p.m. I would expect once you get any slightest opportunity you get, ladies and gentlemen, we must be very good in how we manage our time. We must be very good in how we manage our time. This semester, we must sacrifice a lot. We can't afford to have students who are failing AFM for the 6th time. That's wrong. That's wrong. We must create all the time. So if it is church, for example, you can say you are going to church, say first service. From there now you are free, say for example, from 11 to 1, and explain to your family why, for example, you can't attend 2 masses. Explain to them. We must, in this case here, be able to burn some midnight oil. I'm telling you, I mean, there is no time. There is no time. There is no time. But like last semester, the students that had last semester, those guys worked very hard. I expect you guys to be able to put in even much more time in this exercise here, in this exercise. Now we start straight away. When we talk of reorganization, what are we supposed to know, ladies and gentlemen, here? So we shall be able to advise one another as we progress, but I think I've been able to put in, ladies and gentlemen, a few nuggets here which will be able to help you to remember there is nothing outside here. Let me tell you something. Let me tell you something as I go back to reorganization. Yeah, I am charged here. Let me tell you something before I start this topic. Excellence is not even about how bright you are. In everything, it's not about how bright you are. Trust you me. There is a keyword that has always assisted me. This keyword is great to me. Not even we shall overcome. But everything, if you want to excel, it is about perseverance. Perseverance, what is the spelling? Perseverance, perseverance. You guys will be able to know the spelling. Thinking now the age is catching up. But if you want, if there is any kind of sacrifices that are really needed here, all right? Like myself, where I work for a multinational company. There are deadlines in this case here that somebody will give you something here and they think that you will not be able to make. All right. I'm able in this case here to go straight even to 1 a.m. So we must be able to persevere. We must be able to persevere in everything and you'll be surprised. Like Mwalimu here, to tell you the truth, for RCM to reach where it has reached, I really, for those of you who know me, because they're people that I normally work with very, very closely because I mentor them, I persevere a lot. I persevere a lot. Perseverance is about taking even some little pain. There are guys who really love themselves so much, so that whenever they put, in this case here, an alarm, they put an alarm. The alarm in this case here goes up at 4 a.m. Now, when it goes up at 4 a.m., they hear, ta-dan, ta-dan. There are those 2 voices. There is a positive voice and there is a negative voice. So the positive voice will tell this guy, you know what? Your exam is on 2nd of December. Please wake up. Study. Study. And then there is a negative voice, which in this case here will come and tell this ninja that, you know what? 2nd of December is still very far away. You don't even have to wake up. At first, it starts by cheating you that I just snooze for 30 minutes. I mean, this negative voice is so loud. It's so strong. It's a heavy metal. For you to be able to put out your blankets and then, of course, you get out, you defy that negative voice. It's very few students here. I mean, in everything that we do, we'll always have these voices here. This will be like 10%. This will be like 90%. In wrestling, this will be like a yokozuna. You can't be able to, very few. Once that thought comes that, I mean, let me even pray a little bit. Automatically, that blanket becomes so heavy on you, you sleep. You sleep. And if that happens, then you will be here again crying that I failed FM for the umpteenth time. We must be able to say no to these boys here. If any thought about praying comes, and remember, most of us are not even very prayerful. If a thought of praying comes when I'm inside a blanket, normally what I do, I will always kick off that blanket and then I go to pray outside when I'm seated or doing something different. There are very few people in this world who can manage to fight this. Very few people. And if you are able to manage to fight this, then automatically you are destined to succeed. Automatically, yes. Liz, I hope you're not among those ones who are normally overwhelmed with this negative voice. Liz, I can even see your name. You are not among those guys who are normally overwhelmed. I pray for you. I pray for you, we shall overcome. We shall overcome. So this negative voice will not be able to do what here, ladies and gentlemen, to overwhelm any of us. Now, when we talk of reorganization or restructuring, ladies and gentlemen, I would want you to make a note right away that we normally do what here, somebody? Restructure financially. In most cases, we normally restructure financially distressed organizations. Financially distressed organizations. We normally restructure organizations that are what here financially struggling. Like I gave you a very good example of Kenya Airways. Kenya Airways, we know for so long, Kenya Airways has really been struggling for long. This is the only year when we realize that Kenya Airways is posting a profit. Kenya Airways struggled to the extent that even their shares stopped selling at the stock exchange. I mean, the price went as low to a level that even, I mean, the Nairobi Stock Exchange had to say, it's like now Kenya Airways will start even bribing people to buy their shares. Nobody wanted their shares. There is nobody who would want a company to buy a company's shares for a company that is making losses year in, year out. So in this particular case, ladies and gentlemen, even for KQ now to start making profits, they had to do what we call a restructuring process. And for them, what kind of restructuring do they do? They used to have huge debts, very huge debts. For example, like 80. And equity, what was the government putting in, for example, was like, say, 20. Remember, equity is the capital that is given by the owners of the business. So when KQ realized that, hey, this debt is unsustainable. So what they did, they called the debt holders, those bond holders, the major one, not everybody, the major one. There were three. That time it used to be called Barclays Bank, Equity Bank, Standard Chartered Bank. So they called those three people, the bond holders. They told these bond holders, we are not able to pay you your principal and interest. So of course, at first you tell those guys here, even if you want to kill us today, because we can't afford to pay you. We can't afford to pay you this principal and the interest of yours. Then let's discuss on the very best way forward, because if we die, if you squeeze at us and we die, then you're going to lose your entire bond amount. We would rather talk of restructuring in a way that you may not get much today, but you see, even with the little that we shall be able to be giving you, in the long term, you'll be able to recover the entire bond amount and, of course, even get to profits now. So they did a restructuring, and the restructuring here that they did is what we call a debt equity swap. A debt equity what here? A debt equity swap. So meaning that a good percentage of this amount became what here? Became equity. So assuming in this case, these three companies, debt was 60 million. So those guys were given shares. So they were given shares. So if they were given shares, of course, they brought the 60. Let's talk of 65, for example. So they brought the 65 here, became equity, and that 65, of course, was knocked from here. Meaning that this minus this gives me what here? So the debt amount went what here? The debt amount went down. So once the debt amount goes down, what does that mean? Automatically, the interest rate goes down. Remember, equity holders, you don't have to pay them dividend. Equity holders, we shall not pay them dividends when we are making losses. No, we shall not pay them, so we are not obligated. So in this case here, the interest amount, even the principal being paid on a monthly basis went down. So it gave these guys a breather. You see, this is what we call restructuring. So you can do like a debt for equity. A debt for equity swap means you are exchanging. Yeah, you had bondholders, you had our bonds. Now we are giving you shares. So we swap like this. You return back our bonds, we give you shares. So we are swapping. That's a very good restructuring. Now, ladies and gentlemen, restructuring could also take the form of what we call an organizational structure. You guys know what this is. An organizational what year? Structure. Organizational structure. Where, for example, we have the CEO. After the CEO, for example, we have our directors here. So, for example, we have here the marketing director. We have in this case here the finance, for example, director, and the other directors. Below the directors here, we have ladies and gentlemen, if we are financially struggling, and then we realize that, all these guys here, all these positions, we can't afford to pay the suggested salaries. The salaries that we have been paying these guys here, we can't afford paying them moving forward. Then what do? We can easily consolidate. We can say that this marketing role to be even under the finance what you're director. All right. So in this case here, once we bring the marketing role to be under the finance director, then automatically we shall be like doing away with all this directorate. So we'll have sacked somebody, of course, there in the process. There'll be people be going home. That's unfortunate. But you see, that is all about what we call restructuring. Like I was reading the dailies, somebody was saying in the dailies, and I really agree with this, that what is killing Kenya today is our country's structure. But Kenya had not reached a level where we needed 47, we don't need 47 counties according to that guy. Those counties, you are paying one governor, for example, 2 million. Don't you think just 8 governors, like governors for the old provinces, don't you think 8 governors are just enough? Somebody, what do you think? 8 governors. Why should we have MCAs, in each of these 47 what-year counties? What is it that they're doing, which is very, very special, that we can't just have a few of them? All right. So this constitution of ours has lots of what-year duplications of what-year services here. Yeah, like somebody is saying that we don't need women rep. We don't need women rep. And that coming from a lady, it means that now people are coming to realization that at the end of the day, the people that we put up there are the ones who are eating these things. They're the ones who are eating these things. So then we need to, because for sure, if you look at everything, at times I even sympathize with these leaders. I sympathize with these leaders when they are launching projects which are basically hot air. Of course, I know that there is a lot of theft going on. But you see now, as a president, how do you keep people busy? So at times you'll be forced here to go and just announce projects that are not even going to be done because you've got no money. And there is even a time Moses Kuria came and they said that something about this, public service, that they're taking like 50% of what, and they said that that is what immoral. And remember, the 50% of the income being taken is not going to this lower cadre of employees. Most of it is going up there. So then we need what we call a restructuring, because currently, as we say, Kenya is stressed. Kenya is going through what we call a financial distress, a financial distress. So then we would need to restructure. So ladies and gentlemen, what do we need in our case? So in our case here, what we need to study, number one, the most important thing, if you look at your syllabus, they want us to study what we call methods of measuring what here? Methods of measuring bankruptcy. Methods of measuring what here? Bankruptcy. This is what really is the foundation for this particular topic. Methods in this case that we shall use to be able to measure bankruptcy levels. Talk of bankruptcy levels. Bankruptcy levels. Bankruptcy levels. Bankruptcy levels. And the very first method that I would want us to look at today, after we ignore whatever we have done in the other classes. So the first one that I would want us to look at is what we call the Altman's Z-score model. The Altman's Z-score model. the Altman's Z-score model. Altman's, yes, Paul, thank you very much. Altman's, yes, Paul. Whenever you hear this gentleman, Altman, you must always think, even if you don't know really much about this, you must always think about what we call the Waremas. Waremas. Write this in this one here, Waremas. Very, very important. So whenever you hear of Altman as a model of measuring bankruptcy, as a model of measuring how financially distressed companies are, then you must be able to remember the Altman's model, whose acronym is Waremas like that. Now, ladies and gentlemen, this Altman's Z-score model uses 5 ratios. 5 ratios to measure bankruptcy levels. To measure bankruptcy levels. It uses how many ratios? 5 ratios. And these ratios are the ones that we call X1, X2, X3, X4, and then we have what we call X what here? X5. Those are the 5 ratios here, ladies and gentlemen. Now, please listen. Please listen. This WO normally works, W and O, they work together hand in hand, in pairs. And also in this case here, M and A, they work hand in hand in pairs, like that. All right. I don't know whether you'll be able to squeeze this very well. Ladies and gentlemen, I would want you to squeeze this very well. Please listen and listen to me very well. This WO stands for X1. This one here stands for X2. This one here, E. The E stands for X3. The MA, this MA, I'll be able to explain what it is. It stands for X4. And then, of course, we have Waremas. This S stands for X5. Please write up to there. So what I'm saying, as I expect you guys to write there, is that this X1 is a WO. X2, in this case here, is an R thing. X3 is an E. X4 is a MA thing. And then X5 I mean, is an S thing. So you're talking of Waremas. It is only this WO and MA that are working hand in hand in pairs. Those are the only ones that are married. They're coming in this case here as couples. The others in this case here are singles like that. The others are singles like that. Waremas. Let me know whether you guys have been able to write up to here. Let me know whether you guys have been able to write up to here. Let me know whether you guys have been able to write up to here. Yes. Waremas. Yes. Great. So, ladies and gentlemen, please listen and listen to me very well. When we talk of this WO stands for, in full, this is working capital. This is working capital. This is retained earnings. Retained earnings. This is retained earnings. This one here is EBIT. This one here is EBIT. EBIT. This one here stands for market value. Market value of ordinary shares. Market value of ordinary shares. And this one here stands for sales. This one here stands for sales like that. Stands for sales. Stands for sales. So you have X1 to X5. X1 to X5. And once you understand what they mean, and then I will come here and make these ratios. So how do we make these ratios? How do we make these ratios? How do we make these ratios? It's very, very easy. It's very easy. To make these ratios, we shall have a denominator. We want a quotient. So this will be ta. Then we have here ta. Here we have what we call TL. Here we have ta like that. Ta like that. So it uses, in this case here, how many ratios? 5 ratios to measure bankruptcy. And the 5 ratios are like this. 5 ratios like. So once you remember ta, then we have the last one, which is ta. Then we have the 4th one is TL. Then you're at home. This ta stands for total assets. Stands for total assets. And the TL stands for total liabilities. total liabilities. TL stands for total liabilities. TL stands for total liabilities. All right. So there is something I would want to bring to your attention, ladies and gentlemen. For us to be able to understand this, I have to use a different question. For us to be able to understand this, I would want us to look at this question that was tested. This question that was tested on November 2020, question number 1. 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 Are you able, ladies and gentlemen, in this case here to see the question? November 2020, question number 1. We are looking at this question called November 2020, question number 1. Tell me whether we are there. November 2020, question number 1. November 2020, question number 1. Let me know where once we are there. November 2020. Somebody should be able to share the past papers with the others. It's very easy. You can even upload it here, Bona Paul. You can even upload it here, Bona Paul. It's very easy. 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 I hope you know how to share past papers. November 2020, question number 1. Once you get the past paper, are you able to give me a signal like, Mwalimu, I have this question? It is this question whose part A reads, discuss 4 reasons for restructuring and reorganizing an organization. November 2020, question number 1. So of course, I know this is a free of charge class. I would want to take this opportunity to welcome all of you. Join this class of ninjas. Join this class of ninjas and we shall overcome. We call ourselves CPA ninjas. We are tough ninjas. We are tough ninjas. So if you would want to join us, we are charging 4,800. So this is our number. You need to call this number 0793 555 000 0793 555 000. And then of course we have the other simpler one, although it's really jamming right now because of the traffic. 0719 525,000. 0719 525,000. So I'm just buying time as you guys confirm to me that you've gotten this past paper. As you guys confirm to me that you've gotten this past paper. As you guys confirm. November 2020, question number 1, yes. November 2020, question number 1. Thank you very much. So they want us to discuss 4 reasons for restructuring and reorganizing an organization. Can somebody give me those reasons? Because we should not skip anything. This semester, you're not skipping anything. We shall do everything we come across. Those theories are very, very important. They easily make students, in this case here, see places that they've never seen before. So anybody who can give me these reasons for restructuring and reorganizing an organization, so I'll be able to write them down here very fast. So number 1 is to increase firm value. To increase firm value. To increase firm value. How does this happen, ladies and gentlemen? Remember, when you reorganize an organization, you're going to uplift it from a bankruptcy situation to a liquid one. And once then in this case, you've been able to make this company functional. It is now liquid. Then the entire organization, the entire country, will be able to suspect, will be able to know that now things have started doing what you're working. Like right now, I can assure you, given that now Kenya Airways has been able to get out of the hole, now they're making profits, you'll start seeing the shares of Kenya Airways selling at the stock exchange very soon. Very soon, we'll start seeing shares of Kenya Airways selling at the stock exchange. And when these shares now start selling, of course, the price will keep on increasing. When the price increases, what happens? We shall be able to increase the value of the firm. Because how do we get value of a firm, firm value? We normally take number of ordinary shares times market price per what year? Market price per share. Anytime they want us to get Farm value. Farm value. We normally take number of shares, like Safaricom has got 40 billion shares. 40 billion shares. All right. And then we multiply this with the current market price per share. NOS stands for number of shares. Number of ordinary shares. Number of ordinary shares. Times market price per what year? Times market price per share. So please listen. When I reorganize an organization, automatically, we call this one here the signaling effect, signaling. We call this one here the signaling. We call this one here the signaling effect. That we shall be able to signal to the market now that we shall be able to tell the market now things are good. And the market will be able to behave. The market will want our shares. And once the demand goes up, then the market price per share goes up. Then that means that the farm value will be able to do what here? Somebody will be able to increase. That is really, really very, very important. Ladies and gentlemen, the other one is to have a competitive advantage. To have a competitive, in this case here, what we call a competitive advantage. To have a competitive advantage. Remember Michael Porter. Michael Porter is the father of this competitive advantage, Michael Porter. And if you remember very well, Michael Porter said that we need as an organization to ensure that we are a cost leader. We need to ensure that we are what here? We are a cost leader. And one of the ways of ensuring that you shall become a cost leader is through what we call what here? Reorganization. So if you want a competitive advantage, then reorganize. So that you'll be able to get the loopholes. Where are we losing money? Seal those loopholes. Like, for example, President Ruto reorganized his cabinet. And by the way, are we happy with the reorganization? Are we very happy with the reorganization? The only thing we thought he would also do was to trim down. Oh, they're saying, no, this must be Gen Z's now. This must be hot air. Okay. This must be Gen Z's now. All right. But trust you me, if, for example, he was able to, after all, Ward has it out idea that he's normally the one who makes most of the decisions, then he should have taken a leaner cabinet. You know, once you have a minister in office, look at how these guys travel with all the bodyguards. I mean, they have air travels, and of course, their vehicles following them down here. I mean, to have a minister moving around is not a cheap thing. So if I were him, I would have chosen to become a cost leader. And once you are a cost leader, for example, in East Africa, then Kenya gets a competitive what here? A competitive advantage. Kenya gets a competitive advantage. Kenya gets a competitive, reduced cost. They're giving me points there. Yeah, you can pay in installments, yes. George, you can pay in 2 installments, yes. You can pay in 2 installments here. Number 3, to reduce debts to manageable levels. To reduce debts to manageable levels. To reduce debts to manageable levels. Number 3, reduce debts. This is really key. Reduce debts to manageable levels. Ladies and gentlemen, you know, there are people who do not have a very, very thick skin. There are people, whenever their creditors call them, all right? You even get people, for example, somebody has a Tara loan, he has a Fuliza. Once these guys just start even calling, you'll get somebody even switching off their phones permanently. That's very wrong. We just need to talk to these people and do what we call a debt restructuring. Once you do debt restructuring, then automatically you'll be able to become liquid. You'll be able to become liquid here. All right. Number 4, to stabilize a company. So number 4, to stabilize a company so that the owners can inject can inject more capital, can inject more capital, for example, through a rights issue, through what we call a rights what year, through what we call a rights issue, through what we call a rights what year, a rights issue, a rights issue. So whatever you say, like for example, you could say that number 5, to increase profitability. To increase profitability. That's a very, very valid point, to increase profitability. Yeah, to have a competitive advantage, yes. Ah, great. Great. Thank you so much. I hope now you have all those points. And of course, to avoid winding up. That was another reason for doing restructuring. That's a reason for doing restructuring. To avoid what year? To avoid winding up. To avoid winding up. We have gotten a very, very good assignment. You know, I ran an audit firm by the name of Aura and Co. I think I also do so many things. I do so many things. I do so many things. So we ran an audit firm by the name of Aura and Co. So this time around, we have gotten a very, very serious assignment. All right. Where we are, actually, there are 2 of them. The one, we have gotten a company that would want to be listed. They have a roadmap to be listed. So the very first firm that they would want, the very first thing they would want us to do as a company here is to ensure that they know their current value. Yeah, their current value. So valuation, that's really, really very, very important. So, and of course, you shall be doing this firm valuation. There are so many methods. You could use, like now what I've just shown you there, number of shares times market price per share. But now remember that this is currently a private company, which doesn't have what we call market price per share. It doesn't have. It doesn't have. All right. And then now we have this other situation where we take the cash flows from the future, we discount it. Then the present value becomes the value of that organization. All right. And then now we have gotten also a situation where we have a company which is really, really struggling. And this hitherto was a very, very serious company which has basically been brought down on its knees by directors. If there are enemies to any business, enemies to any business, ladies and gentlemen, are directors. Directors. Look at, you know, you guys are accountants. I'm so sure you guys are working. If you look at, for example, you know, we have various stakeholders for any company. We have suppliers, we have customers, we have employees. You as an accountant, which is that stakeholder that disturbs you most? It is the directors. So you get like those days when I used to be a junior accountant, a director is sitting somewhere there in Mombasa and is calling you very fast to organize 20,000 because we would want to have one for the road. I mean, so these directors are able to mess up with so many things. But now, fortunately, these guys who are based in Nakuru, they've realized, I mean, we are the problems. So they've come in this case here to Aura and Co, which is a composite licensed audit firm, tax and advisory services firm. All right. So they've now come to us. So number 1, I gave them my own example and told them, even myself, I used to find myself in those kind of problems here. And what I did, because I realized I was the biggest problem at the RCM, I got a job outside. Up to date, you can't convince me. Like, of course, you guys know that we are very many at RCM. We are getting very serious cash flows. But there is no way I will ever resign there to come and teach like 100%. Because if I come here with all my big visions, I'm so sure will not be, you know, cash flow is king. Cash flow has to be protected. So then if you don't work hard a lot, then automatically you are going to have this company winding up. So we also do restructuring. Last point, we do restructuring to avoid winding up of a company. Permanent closure of a company. Permanent closure, yeah, they divert the money. This is very good. They divert the money from the business and go and do crazy things there, And then now we look at number two here. Number 2. So number 2 of this question is quite an interesting one. They're telling us there, Professor Edward Altman's model for prediction of bankruptcy is given as follows. So remember the question you are doing. Sorry, I grabbed this one. The question that you are doing is November 2020, question 1. Question 1. So we are doing November 2020, question number what here? Question number 1. This is the question you're doing. So Professor Edward Altman's model for prediction of bankruptcy is given as follows. They've given a Z-score there. So we have here 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus 0.999x5. X1, X2, X3, X4, and X5 are the financial ratios, which according to Professor Altman have the discriminating power. Have the discriminating power, where X1 is net working capital over total assets, X2 is retained earnings over total assets, X3 is operating profit, EBIT over total assets, X3 is market value of equity, shares over book value of debt, including preference shares, X5 is sales over total assets. Now, could you kindly do me a favor, just a small favor? Look at the balance sheet given down there, and they give me the total assets from the balance sheet given there. Are you able to see the total assets from the balance sheet? There is a balance sheet given there. Are you able to see the total assets? I can see Alpha Limited statement of financial position. I can see total assets. How much do we have there? Thank you so much. Total assets here are 400,000. So for me to be able to get X1, I can see X1, I need working capital. I need working capital. Can somebody in this case here remind me the formula of getting working capital? Can somebody remind me the formula of getting working capital? Is there somebody is able to remember working capital? Normally we look at, CA minus CL. So anytime they want us to give them working capital, we shall take CA minus CL. So remember, CA stands for current assets. CA stands for current assets. I hope you guys are noting somewhere there. But CA stands for current assets. And then CL stands for what we call current what year? Current liabilities. Yeah, Brian has a different paper. Is there somebody who can assist Brian? Is there somebody who can assist Brian by sharing the... Brian, are you in our paid group? Brian, could you be in our paid group? If you're in our paid group, I'm so sure somebody will be able to share the question there very fast. So can somebody share this paper in our AFM paid group before we continue? If in this case here you don't share the paper in the paid group, then shared. I told you. So now I hope you are comfortable. I hope you are comfortable. I hope everybody now has exactly what we are doing. I hope everybody now has exactly what we are doing. What we are doing. Thank you so much. Thank you so much. Ladies and gentlemen, I would want us to look for, I hope you have written there current assets, current liabilities, current assets, current liabilities. So is there somebody who is able to see the current assets? Current assets, please go to your assets register and pick current assets. Go to your assets register and pick current assets. How much are they? Current assets. I can see Agnes and Lillian. They're giving me 100,000. How about current liabilities? Go to your liabilities. Go to your liabilities section. Go to your liabilities section. Go to your liabilities section, and you should be able to see the current liabilities. If you go to the statement of financial position, the liability section, you should be able to see the current liabilities, which somebody has told me they are 20,000. So then these will be 100,000 minus 20,000, which will end up giving me 80,000. So is that true? Is that true? Thank you so much. So can you kindly go ahead and give me X1? Please go ahead and give me X1. See where X1 is. X1, they want you to take working capital, which is 80,000. We divide this by total assets. Total assets, in this case here, you guys have given me the TAR. Total assets, they are 400,000. 400,000. So then this one here will end up giving me what figure? Yeah, thank you very much, Lillian. So we have here 80,000 divided by 400,000. Thank you, Mzembi. 0.2. 0.2. Mzembi, if I may ask, is that a spelling mistake? Is it supposed to be Mzembi or Msembi? I know so many Msembis. This will be the first one. First time hearing about Mzembi. Is it a typo or it's Mzembi like that? Okay. I need to get used to that. So then are we together, ladies and gentlemen, as regards to how we have gotten X1? Are we together as regards to how we have gotten X1, all of us? Please don't fear this ninja. Ah, Chogo, I can see you around here. Don't fear this ninja. This ninja is normally the easiest to work with. It's normally the easiest to work with. It's normally the easiest to work with. Then let's go to X2. You see, X2, they want me to pick retained earnings. X2 is here. They want me to pick retained earnings over total assets. Please remember that these retained earnings are the ones we pick from the balance sheet, not the income statement. They're the cumulative, because if we are able to accumulate earnings to our retained earnings basket, then the company will not be wound up. Why? In this case here, we normally get ourselves in financial distress positions. It's because we don't retain. If, for example, you get somebody here who is salaried, and they are really struggling, in most cases, please sympathize with them. But I mean, the biggest problem is that they do not retain. They don't retain. Because if you remember, and we shall be looking at this, Gordon's formula, we have Gordon's formula, the one that talks of growth rate. Growth rate. If you remember Gordon's formula, the one that talks about growth rate, we have got two formulas for getting growth rate. We have BR, and then we have the other one that has got an nth with something. So in this case here, G will be BR. If you remember, this B stands for retention ratio. How much are you able to retain? If, for example, you're getting 100,000 and you're able to retain 40%, that means you're able to retain 40,000. But if you retain more, and then, for example, you come and retain the amount to some good assets, where you're able to get return on equity, then you shall be able to grow. That to grow is a function of two things. How much do you retain? And once you retain, how much will you get as a return from your investments? So when you retain, and then you put this money under the mattress, nothing, you can never grow. You retain, take this money to money market fund. After you've taken this money to the market fund, and then you realize money market fund now is getting full. Now you have about 100,000. Get that money from there. Think long term. Buy government bonds. So you see, now you're growing. You're growing because government bonds will be able to give you return on your equity. All right. Yeah. Oh, depressed economy. No. TJ, I repeat, okay. I repeat, TJ. I don't think in this case here the economy is depressed. TJ, there are people, you know, there is a place I went the other time and told people how, I mean, there is no money in Kenya. And then somebody told me, my brother Aura, have you gone around Kilimani, for example? Are you guys in this case here seeing the kind of houses which are being built there? Are those guys building with papers or money? So do we have money in Kenya or don't we have money in Kenya? So jamani niambia, ati wewe daktari, sema wewe ndio una pesa. Usikaseme Kenya hakuna pesa. Sema wewe ndio una pesa. Sema wewe ndio una pesa. Nikasema kweli. Mimi ndio sina pesa. Oh, okay. Oh, it's wash. What do you mean? I don't know. So CPA Rono wants me to repeat this. X2, I hope CPA Rono, we are talking about this X2, which is retained earnings divided by total assets. So, and I've just said here that these retained earnings, you see, we have retained earnings for the year. Retained earnings for the year will be in the income statement. Retained earnings for the year will be in the income statement. But you see now, if you're retaining for the last, say, 5, 6, 7 years, cumulative normally goes to the balance sheet. So retained earnings from the balance sheet. Are you able to see the retained earnings from the balance sheet? Bonarono, look at the balance sheet there. Look at the balance sheet. If you go to the equity, are you able to see 120,000? So we have here, if you go to the equity retained earnings, retained profit, we are seeing 120,000. We divide this by what here? Total assets. Total assets in this case will remain at 400,000. Man, Rono, are we together now? Rono, are we together? Are we together there? Are we together there? And somebody has told me, now this is 0.3. This is 0.3. 0.3 like that. X2 is 0.3. Now from there, ladies and gentlemen, is there somebody who can come and assist Mwalimu here by now getting X3? by getting X3. You see, X3 is very, very easy because X3 is EBIT divided by TA. X3 is EBIT divided by TA. You can't tell me that EBIT will be found in the balance sheet. EBIT is earnings before interest and tax. This is an IS thing. This is an income statement thing. So if you got the income statement given in this question, there are two statements given in this question. If you got the income statement given in this question, you can see the income statement, ladies and gentlemen. Are you able to see? Are you able to see, in this case here, EBIT? EBIT. Is there somebody who is able to see? Thank you very much, Legacy. You must be a very good student. This Legacy guy must be a very good student because Legacy has known EBIT is profit before interest and tax. And it is the one we vividly call operating profit. It is the one we call operating what year? Profit. Never forget that. EBIT is the same as PBIT. It is the same as profit before interest and tax. And it is the one we are calling operating profit. So are you able to see that operating profit somewhere there in the income statement? Yeah, it is 40,000, isn't it? It's 40,000. Thank you very much, Dorothy. It's 40,000. It's 40,000. It's 40,000 like that. And therefore, then X3 will be this EBIT. We divide it by what year? By total assets. We divide this by total assets, which are 400,000. So we divide this by total assets, which are 400,000. So 40,000 divided by 400,000, that will end up giving me what figure? See, for Sylvia, it is 0.1. That is very good. 0.1 like that. That is X3. That's X3. That's X3. Now, I would want us to go to where the rubber meets the road. X4 calculations. So these X4 calculations, first of all, I would want somebody to give me the market value of ordinary shares. I would want somebody to come and give me the market value of ordinary shares for this company. This is so important. If I were you, I would write this and put a yellow highlighter. I would write this and put a yellow highlighter. I would write this and put a yellow highlighter. How much are the ordinary shares worth in the market? I've already given you the firm valuation formula. I've already given you the firm valuation formula. I've already given you the firm valuation formula. I told you, ladies and gentlemen, that anytime you want to get market value, you shall always take the number of ordinary shares times market price per share. Anytime you want to get market value of ordinary shares, you shall always take the number of ordinary shares times market price per share. But now the question is, how shall we be able to get, please write this in full. This represents number of ordinary shares. Can somebody give me the formula for getting number of ordinary shares? Can somebody give me the formula for getting number of ordinary shares? Somebody. Give me the formula for getting number of ordinary shares. How do we get number of ordinary shares? Somebody help me out here. How do we get number of ordinary? No. But you've tried. Number of ordinary shares. How do we get number of ordinary shares? Somebody some time back told me, Mwalimu, I'll pick the share capital. I divide by the figure that is in brackets. I'll pick the share capital. To get number of ordinary shares, we normally take the share capital. Divide by par value. We divide by par value. You take the share capital, you divide by par value. Yeah, Abigail, yes. Elsie, yes. You take the ordinary share capital given in the balance sheet, of course. You can see financed by. So you're able to see the ordinary share capital is 100,000. So you're able to see this is 100,000. 100,000. Divide this by the par value, the one that is given in brackets there. The par value given in brackets there, are you able to see that par value given in brackets there, which is 10? Is there somebody who is able to see the par value in bracket 10? Thank you very much, Roscaro Bungu. Yeah. Great. Thank you so much. So 100,000 divided by 10, this gives me 10,000. So this gives me 10,000 shares. So this gives me 10,000 shares. This gives me 10,000 shares. This gives me 10,000 shares. Then I will be able to get now this market value of ordinary shares. Because now I know the formula, but first of all, before I proceed, I would want to know whether all of us are able to see that 10,000 shares. I would want to know whether all of us are able to see that 10,000 shares. How we got them? 10,000 shares. 10,000 shares. Thank you so much. 10,000 shares, we've seen how we're getting this. So then come here and pick the 10,000 shares. Number of ordinary shares here, they are 10,000. Number of ordinary shares here, they are 10,000. Times, have they given me? They'll always give you. In this, they will always give you. Somewhere there, they will tell you, look at the last sentence before required. Look at the last sentence before required. The firm's ordinary shares are currently trading at 15. The firm's ordinary shares are currently trading at 15. So 10,000 times 15. So this will end up giving us 150,000. So this is the market value of ordinary shares. Market value of ordinary shares. So I need two things. For me to be able to calculate X4, I need market value of ordinary shares. And then number two, I need, in this case here, the total liability. The total liability of the firm, which I would want to hear from you. What is the total liability here? Which I would want to hear from you. What is the total liability? Because I need two things. To be able to get, ladies and gentlemen, X4. To be able to get X4. To be able to get X4, we need two things. We need market value of the firm, which is NOS times MPS. That we need. And then number two, we need total liability. Number two, we need total liability. So I can see somebody is giving us 140,000. Now, there is one thing that I would want us to appreciate from the word go. There is one thing I would want us to appreciate from the word go. Ladies and gentlemen, I would always want you to do this. See, there are two ways of doing this. When we talk of total liability, there are two ways of doing this. We'll come and take current liabilities plus non-current liabilities plus any preference share capital given. Plus any preference share capital given. Because preference share capital, you know, these guys, basically, they're going to get what we call a fixed return. Whether you're making loans or rather losses or profits. These guys, if their preference share capital is 10%, they'll always get 10% of what they gave us. And remember, preference share capital, unlike equity, preference share capital, at the end of the day, their money must be refunded. And that is why if you look at, even if it's AFR, preference share capital nowadays, they are normally classified as what here? As a liability. Preference share capital, if I were you, I would have written this somewhere there in my mother tongue. But preference share capital is classified as a liability. Preference share capital is normally classified as what here? As a liability. Preference share capital is normally classified as what here? As a liability. Have we been able to pick that statement? You see here, we are very, very lucky. Here we are very, very lucky. If you look at where they have given us the formulas, where they gave us the formula, they told us X3. These guys changed things here. They told us here X3. They told us X3 is market value of equity, is market value, that's X4, actually it's X4, is market value of equity shares divided by book value of debt, including preference what here? Shares. So shares are basically being lumped together with what here? Debt. So what have we said about preference share capital? I want to make myself clear. Anytime they talk about total liability, we shall always be taking current liability plus non-current liabilities plus what we call preference what here? Share capital. Can you kindly put this, like you highlight this? Can you kindly highlight this? Can you kindly highlight this? Can you kindly highlight this? After you highlight that, I would want to make something very, very clear. Allow me to make something very, very clear. Allow me to make something very clear. And for all this time, CASNEB will always give you two answers for this. CASNEB will give you two answers for this. Is there somebody who is able to see the current liability here? Is there somebody who is able to see the current liability here? Please go to your balance sheet. Are you able to see the current liability? Is there somebody who is able to see the current liability? Wait, they're not now talking to me. Now they're not talking to me at all. 20,000, isn't it? So current liability there, we have 20,000. We have 20,000. We have 20,000. How about non-current liabilities? How about non-current liabilities from your balance sheet? Non-current liabilities from your balance sheet. What are you able to see there as non-current liabilities from your balance sheet? Yeah, I can see 10% debenture capital. Debenture is a loan. Long-term loan. Long-term loan. And that long-term loan, 10% debenture capital, I can see a figure of what year? I can see a figure of 80,000. I can see a figure of 80,000. I can see a figure of 80,000. How about preference share capital? Is there somebody who is able to see a figure of 40,000 for preference share capital? Is there somebody who is able to see 40,000? So then are you able to give me the answer here? Are you able to give me the answer here? What are we able to get as our total liability? Total liability. What are we able to get as our total liability? So this will be 20 plus 80, this is 100. So that will be 100 what year? 140,000. So this will be very, very correct. However, I want to draw your attention to something very important, and then we shall be able to make a decision. We shall be able to make a decision. Look at the X4 formula given to us. The X4 formula given to us, ladies and gentlemen, X4 formula given to us in the question, they have told us it's market value of equity shares over book value of debt. Book value of debt. So the question is, when you go to your debt book, where you are capturing, in this case here, your debt holders. Your debt holders. Your debt holders are bond holders. Current liabilities can never be there. Current liabilities can never be there in the book of our debt holders. In the book of our debt holders, current liabilities will never be there. I want to make myself very, very clear here. Whenever you're given a formula, and then you see the examiner talking about what year? Book value of debt. Whenever you see the examiner talking about book value of debt, then our formula changes slightly. Our formula changes slightly. That our X4 will be equal to market value of ordinary shares, market value of ordinary shares. We divide this by market value of ordinary shares. We divide this by TLL. TLL. We divide this by TLL. Where TLL stands for what? This is the total long-term liabilities. The total long-term liabilities. Total long-term liabilities are also what we call the non-current. No, long-term means beyond a year, more than a year. So these are the ones that we call non-current liabilities. Please let me know once you're able to write up to here. TLL. TLL. So TLL will be our total long-term liabilities, which are also known as our non-current liabilities. Non-current liabilities. So then if that is the case, and then remembering the fact that preference share capital will always be part of your long-term liabilities. Because those guys, you owe them. You owe them. Whether you're making a profit or a loss, you owe them. You owe them. All right. So in this particular case, then our total long-term liabilities will be these non-current liabilities, and there are 80,000 here, plus our preference shares, who are 40,000, which will end up giving me how much here, somebody? Which will end up giving us 120,000. Remember, short-term liabilities, basically, these are not debts. These are basically like debts which we accrue because of selling, like payables, etc. But if you go to the book of debt holders, the book of debt holders, you will see the bond holders, 5-year bonds, 3-year bonds. Those are the kind of debts we are talking about. But again, remember, in an exam, I've always shared with you the marking schemes. In an exam, the examiner will allow the two. But you see, strictly speaking, ladies and gentlemen, whenever the examiner talks of book value of debt, we shall always be looking at the TLL, the total long-term what liabilities. So I would want us to take a stand here because I know I've been in this game for so long. Which one do you want us to adopt like forever? Would you want us to be using this TLL, or do you want us to use just this total liability? Let's take a stand as a class. Let's take a stand as a class, because the two answers will be correct. I mean, they will not be the same, but they will always be allowed. The stand that I would want us to take, ladies and gentlemen, we shall only be looking at the total long-term liabilities. Now we are making a stand here. We shall be looking at the total long-term liabilities. We are making a stand. We shall be looking at the total long-term liabilities, those liabilities which are in our books. So if that is the case, can you then kindly go ahead and give me X4? X4. Are you able to remind Mwalimu what the market value of shares were? I can remember that very, very well. They were 150,000. And then we shall come and divide this by the total long-term liabilities, which are 120,000. So 150,000 divided by 120,000. So then this one will give us what figure? This one will give us 1.25, like that. This will give us 1.25, like that. That's our X4. So please, I repeat, from today moving forward, let's be using total long-term liabilities. I want, even when I'm marking scripts, I should be able to know that these are scripts for my student. I'm lost. How you got the 150K? I'll be able to repeat. How you got the 150K? I'll be able to repeat. The 150K is the market value. The 150K is the market value for ordinary shares. I will repeat. And I will use even a different method. Market value. I like students who ask questions of ordinary shares. So this market value of ordinary shares, Chogo, if you look at this equity, the ordinary shares given there, I can see the par value is 10. And at a par value of 10, what is the share capital? The share capital is 100,000. The share capital is 100,000. But you see, now we are no longer selling the shares at 10. Now we are selling these shares at how much? What is the market price per share? We are selling these shares at how much? We are selling these shares at how much? At 15. We are selling these shares at 15. So then that will correspond to what share capital? And therefore, the market value of ordinary shares, the market value of ordinary shares will be 15 times 100,000. 15 times 100,000 divided by 10. 15 times 100, I really like this method. It's good even that trouble you asked. Myself, I'll always work with this method. I'll never use that method of gnosis. Myself, I'll always work with this formula. Got it? Great. So are you able to see that at the end of the day, we'll get this 150,000? Are you able to see that at the end of the day, we'll get 150,000? 150,000? Yeah. 150,000? Yes. 150,000? Yes. All right. So then we have here 150,000. I like this method, cross multiplication. Par value equals the current share capital. How about my market price per share? How much share capital will be worth? And then how do we get our TLL, our total long-term liabilities? How do we get our TLL? Total long-term liabilities. Remember, it is total long-term liabilities. Total long-term liabilities, including preference. So remember, this will be non-current liabilities plus preference share capital. So the non-current liabilities, I can see the bonds. I'm able to see the bonds there, the bonds, the debentures. I'm able to see debentures of 80,000, and preference share capital of 40,000. So this gave me 120,000. And this is what I did exactly here. So I took the market value of shares of 150,000, I divided this by 120,000, which gave me 1.25. Yeah, we shall overcome. Thank you very much. That's a very serious terminology. Very serious terminology. Very serious terminology. And perseverance. We must persevere. We must persevere in anything that you're doing. We must persevere. We must persevere. So they come and they give us X5. I love X5 so much because I know that this will be sales divided by total assets. So are you able to see the sales, CPA? I don't know. Are you able to see the sales? Are you able to see the sales? Are you able to see the sales? Sales is the same as revenue. It's also the same as turnover. So this is 400,000 divided by the total assets that you guys had given me long time ago. You guys, long time ago, you gave me the total assets. Long time ago, you gave me the total assets. They were also 400,000. They were also 400,000. So then this will end up giving me what figure? This will end up giving me exactly 1. There is one figure that I robbed of mine here, which is very unfortunate, but you guys are my children. You should be able to assist your father here. Is there somebody who can remind me what X3 was? Is there somebody who can remind me what X3 was? X3 was 0.1. X3 was 0.1. Now, ladies and gentlemen, now that I have my 5 ratios, and these 5 ratios, I've gotten them using Waremas. Then now I should be able to go ahead and plug them in the Z equation, which shall always be given by your examiner. Are you able to see some Z equation? Are you able to see some Z equation? Are you able to see some? This Z equation will always be given by your examiner. So this Z is 1.2x1 plus 1.4x2 plus 3.3x3, 3.3x3 plus 3.3x3 plus 0.6x4, 0.6x4 plus, then we have 0.999, 0.999 x5 like that. Now, you know, this will be given by your examiner. Don't cram this. This has always been given. The Z score, the Altman says Z score formula will always be given. So yours is to plug in. So come and tell us Z will be 1.2x1, x1 which is 0.2, plus 1.4 x2, x2 is 0.3, plus 3.3 x3, x3 is 0.1, plus 0.6 x4, x4 is 1.25, plus 0.99 x5, x5 in this case here, which is what here? Which is 1, x5 which is 1, like that, x5 which is 1. So then you take your calculator here and do this right away. You do this right away using just your calculator, all of this punched in once. I mean, at this level, you don't start doing like this, and you write plus this. No. Everything once, and then you give me the Z score. So like Linda is giving me 2.1. Linda is giving me 2.139. Linda is giving me 2.139. Ah, Linda, you got it wrong. It must be a typo. It must be a typo. Pieros Chepkemoi 2.739. 2.739. So this is our Z score. And then now you go to the Z score scale. Z score scale. Remember the Z score scale, the Z score scale normally goes like this, 1.8, 2.7. You must cram this scale. The scale has to be crammed. The scale has to be crammed. The Z score scale. The Z score scale must always be crammed. The Z score scale must always be crammed. The Z score scale must always be crammed. These two numbers must always be crammed. Put here. This question, this examiner, I think, sympathized with students. He sympathized with students and they gave them some statement. If you look at the statement before required, he told us in this model, a Z score of 2.7 or more indicates no signs of failure. And a Z score of 1.8 or less indicates there are signs of failure. So he gave us those figures of 1.8 and 2.7. Very good examiner, but you can't get that kind of an examiner in these modern days. When CASNEB in this case here needs you. I mean, also you guys are very, very unfair to CASNEB. You know, like when students say that, It's like now this CASNEB wants us to be shareholders. That now even they have been able to do Tower 2. It's like now they're planning to do Tower 3. I think that's really, really unfair to CASNEB. Is anybody who thinks that CASNEB is taking you guys up like shareholders? Is there anybody who has that kind of a thought? What do you mean, Sherry? I don't think so. 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 No. We are overcoming. Ladies and gentlemen, should you do your Z score, and then you realize that your Z score for your company falls here, it means that this company is 100% bankrupt. 100% bankrupt. Less than 1.8. Less than 1.8, 100% bankrupt. In between here, we talk of 50% bankrupt. In between here, we talk of 50% bankrupt. 2.7 and above, we talk of 0% bankrupt. I mean, no bankruptcy. No bankruptcy. So it will be always very, very important for you to know that if you calculate a Z score and then get a Z score of 1.8 or less, then your company is 100% bankrupt. If your Z score falls in between 1.8 and 2.7, it's 50-50. It's 50% bankrupt. If it falls, in this case here, more than 2.7, then it is 0% what year? Bankrupt, i.e. successful, i.e. successful, i.e. successful like that. Successful, i.e. successful, successful, successful. Yeah, great, successful, successful. So look at the figure that you have here. Look at the figure that you have here, 2.739. Is this company, they called it a name, they called the name. Let me see the name of the company. Let me see the name of the company. Alpha Limited. So Alpha Limited Z is 2.739. So this is, in this case here, more than 2.7. It's more than 2.7. So it doesn't show any signs of bankruptcy. Alpha doesn't show any sign of bankruptcy. Does not show any sign of what here? Bankruptcy. i.e. it is a successful company. It is a successful company. It is a successful company. Because 2.7 is really high. It's really high. It's really high. Where did 3.3 come from? Good question from Esther Irungu. Where did 3.3 come from? Remember, Irungu, you are given an equation. Irungu, if you can look at your past paper very well, you are given this Z equation. Remember, you're given the Z equation, Irungu, which says 1.2x1 plus 1.4x2 plus 3.3x3. I agree with you that x3, the figure was what here? 0.1. But you see that it has a coefficient here. It has a coefficient here. I don't know whether you're able to understand. It has a coefficient. It has a coefficient. It has a coefficient. So up to here, Esther, have you been able to see the 3.3 where it came from? It's the coefficient given in the question. Thank you so much. Thank you so much. Any other question, ladies and gentlemen? Any other question? Any other question? Please feel free to ask questions. Any other question? Any other question? So can I go to something different? Can I go to something different? So you see, Roman 2, they want me to comment on the results obtained in B1 above. In B1 above, comment on the results. So comment on the results obtained in 1 above. I'll come here and say to the comment, write comment here and the line. So the result is the Z, which is 2.739. I will draw that number line, 1.8, 2.7. All right. So in this case here, no bankruptcy, 0% bankrupt. 0% bankrupt. So that will come and write here, this is more than 2.7. It's more than 2.7, meaning that alpha is 0% bankrupt. Meaning that alpha is 0% what here? Bankrupt. It doesn't show any signs of bankruptcy. It is what here? A successful organization. It is a successful organization. It is a successful organization. It is a successful organization. What is the time, Paul? Paul, what is the time there? What is the time there, Paul? Great. Good questions. Good questions there. Good question there. Yeah, Collins, I'll be able to respond to yours first. You see, Collins, for example, if we calculated Z and got, say, for example, Z of 0.8, if we got Z of 0.8 here, what comment would have you given? Where is 0.8? 0.8 is less than 1.8. 0.8 is less than 1.8. So automatically that would mean that this is 100% what your bankrupt. 100% bankrupt. Now, where is 2.739 that you have just computed? It is way more than what your 2.7. It's bigger than 2.7. It's bigger than 2.7. And if it's bigger than 2.7, this gauge tells us that if it's more than 2.7, this thing tells us what here? It tells us automatically that it is 0% bankrupt. You know, what I've always seen out of the many years, ladies and gentlemen, that I've ever marked these CASNEB exams, you'll get some students, in this case, you know, they go to Roman 2, and then they tell the examiner now for the comment, refer above. I don't know what so many students are used to that. But I already have written now a comment. No, you shall always do what I've done. You should always repeat. When the examiner tells you number 2, you write number 2, comment, and then you write it again. You should always repeat like that. Now, Esther is asking a very good question there. Why work out the watermarks, yet we can just pick figures from the formula? Indeed, Esther, you are very right. And I'm going to show you that whenever the examiner gives us the formula, we shall always work with the examiner's formula. We don't even have to write down watermarks. And at times like this other semester, the examiner was able to confuse students so much. But you see, Esther, in most cases, for X1 to X5, you can't be given the formulas. X1 to X5, you will not be given the formulas. I can tell you that. So if you're not given the formulas, and then you're not in a position of remembering watermarks, you get a 0 in the entire question. You get a 0 in the entire question. You get a 0 in the entire question. All right? Mapema do your best. Yeah, like CPA Rono is saying, like CPA Rono is saying that most Kenyans are below. Or somebody should be able to share this. And again, Lillian, remember Lillian, remember Lillian, you're going to get this video. If someone doesn't share the workings, but I believe we have good friends here, they should be able to share what here, they should be able to share the workings. Now, ladies and gentlemen, this ninja has asked for a homework. He's a very, very serious ninja. He's a very serious ninja. So we have here December 2022, question number 4. December 22. December 2022, question number 4. December 2022, question number 4. December 20. Yeah, Elizabeth, we're going to the next method. We've already done the first one. We're going to the other methods. We're going to the other methods in a few minutes. I don't understand the comments you can write. The comments you can write. The comments you can write. So remember, the comments, they are always based on the gauge, the scale. So this scale, we have here 1.8, we have 2.7. I'll just give you a few examples. So remember, in this gauge here, if you get a Z score which is less than 1.8, it means 100% what here? Bankrupt. 100% bankrupt. If you get in this case here between this and this, it means that your company is 50% bankrupt. Anything which is more than means that it is 0% bankrupt. Let's look at various. So this gauge, you must cram it and you must write it like that. So let's look at, for example, if RCMZ is 1.5, if RCMZ is 1.5, yeah, somebody wants us to do April 2024. If RCMZ is 1.5, where will we be? Where will we be if RCMZ is 1.5? Our region, where will be, where is our region here? So we have A, B, C. If RCMZ is 1.5, where are we? Broke. We are at A, isn't it? Because you see here, 1.5 is less than 1.8. It's really something very easy. 1.5 is less than 1.8. So this will automatically put me at A, and therefore we are 100% bankrupt. What if, for example, RCMZ is 4? If RCMZ is 4, what if our RCMZ is 4? Yeah, we are rich. I like what Rono is saying there. So if RCMZ is 4, where is 4? 4 is more than 2.7. 4 is more than 2.7. So it means automatically that RCM is rich. RCM is rich, yes. And of course, if it was to fall, for example, like at exactly 2, I'll ask myself, where is 2? 2 is in between here. So you have 50%, or what this gentleman will say, 50% poor, isn't it? Or 50% rich. All right. All right. So I hope that is now helpful, which now closes the chapter for this, which closes the chapter for this. Now, gentlemen, from there, I will be able to take you straight away to this. You'll allow me to skip part A in the interest of time, and then we look at part B. I just guide you. I would want to guide you. So B, the Altman's formula for prediction of bankruptcy is given there. And this examiner was very, very bright. Maybe it was myself. No, I don't set exams. So he said there, Z score is 1.2x1 plus 1.4x2 plus 3.3x3 plus 1x4. You see, normally x5 is the one that has got one coefficient, or 0.999. So he took this as 1x4. 1x4 plus 0.6x5. And then he went ahead to give us where x1 is working capital over total assets, x2 is retained earnings over total assets, x3 is earnings before interest and tax over total assets. We have x4 is sales over total assets, and then we have x5 is market value of equity over book value of debt. You see there, he has changed something. He changed something in this case ostensibly to ensure that the students see dust in an exam. So it means that there is no way we shall be able to do what you have to use watermarks here. We shall be able to go the way that this lady is talking, because the examiner has given us the formula. We are doing December 2022. Question number, we are doing December 2022, question number 4. Question number 4. So if I'm the one doing this is what I will do. They have given me 3 companies. So I have company A. So for company A, then I would want to get X1. So X1, they have told me it's working capital over total assets. Working capital over total assets. So are you guys able to see for company A? For company A, is there somebody who can see our working capital for company A? Company A. Anybody who is able to see working capital for company A? Anybody who is able to see 4,000, isn't it? So working capital here is 4,000. Here the examiner was very good for us. He even gave us everything. So company A, are you able to see the total assets for company A? There is a column there for total assets. Is there somebody who can see total assets for company A? 200,000. 200,000. So are you able to give me that answer? Somebody for company A. Are you able to give me that answer? Are you able to give me that answer? 4,000 divided by 200,000. Is there somebody who can give us that answer? Thank you, Agnes. Thank you, Lillian. So Lillian is giving me 0.02. 0.02. So I can't mix. Don't mix things. We are handling company A to the very end. Then we go to company B. Not company B, but X2, I mean. X2. So we shall get X1 to X5 for company A until we get the Z value for company A. So X2, they're telling me that X2 is retained earnings over total assets. So retained earnings over total assets. So are you able to see the retained earnings here, ladies and gentlemen? For company A. Is there somebody who can see the retained earnings? Retained earnings, 60,000, isn't it? So this is 60,000, 60,000 over total assets of 200,000. 60,000 over total assets of 200,000. So can you kindly give me this ratio? So if it's company A, just hold company A, do X1 to X5 for company A. Agnes tells me 0.3. 0.3. Then we go straight away to X3. Use the formula the examiner has given you always. The examiner gives you a formula, use the formula. So X3 is EBIT over total assets. X3 is EBIT over total assets. So is there somebody who is able to see the EBIT there? EBIT. Anybody who is able to see EBIT? For A, remember we are holding our fingers on A. So EBIT is 10,000. So EBIT is 10,000 divided by total assets again, 200,000. So then is there somebody who is able to give me this figure? Is there anybody who is able to give me this figure? Is there anybody who is able to give me this figure? According to Lil Agnes, they're giving me 0.05. 0.05. Then we go to X4. X4, you can see this examiner wanted to mess me up, but who am I? Who is my God? So it is sales over total assets. So are you able to see sales for company A? Remember, everything is for company A. Everything is for company A. Company A. Everything is for company A. 2 million, right? So they're telling me that sales for company A at the very corner is 200,000 actually. It is 200,000 actually. 200,000 actually. You divide this by the total assets, which are 200,000 as well. So is there somebody who is able to see one there? One. And then we go to X5 now. They've given me a formula there. They're telling me X5, 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 X5. It's market value of equity. Fortunately, we have these things. Everything, we have it. We have everything. Are you able to see market value of equity or market value of shares? Yeah, 20,000. So we have here 20,000 divided by 20,000 divided by, in this case here, of course, there are no two liabilities there. So remember, it's market value of equity over book value of debt. And I can see they have given me the book value of debt will be the liabilities there, which are 120,000. So then, ladies and gentlemen, this here will end up giving me what figure? This will end up giving me what figure if you're following? This will end up giving me what figure if you're following? 0.17. 0.17. So then if that is the case, please go ahead and give me the Z-score. Are you able to see in this case here the Z-score? The Z-score formula, it has been given to me there. Z-score is 1.2x1 plus 1.2x1 plus 1.4x2 plus 1.4x2 plus 3.3x3, 3.3x3 plus 1x4 plus 0.6x5. Then come here, so it will be 1.2x1. X1 will be 0.02 plus 1.4 times x2. X2 will be 0.3 plus 3.3x3. X3 is 0.05 plus 1 times x4. X4 is 1 plus 0.6 x5. And x5 is 0.17. Can somebody in this case here, perseverance? Because I'm so sure right now there must be somebody who is seeing these figures and they can't even understand because now they've switched off their minds. They've switched off their minds. I always call this perseverance. Keep on pushing, keep on pushing, keep on pushing. So according to Lillian, she's getting 1.711. Can I get some confirmations, extra confirmations? Yeah, Shayla has also confirmed 1.71. Shayla has also confirmed 1.71. 1.71. So are you able to remember? Thank you very much, Agnes. Then are you able to remember our gauge? Have you been able to see our gauge? Have you been able to see our gauge? Have you been able to see our gauge? Here the gauge wasn't provided. Remember, this is 100% bankrupt. 100% bankrupt. This is 50% bankrupt. 0% bankrupt. So where is 1.7? Where is 1.71? Yeah, 1.71. I'm told 1.71 is less than 1.8. It is in this A region. It is in the A region. So this is 100% bankrupt. Company A is 100% bankrupt. Company A is 100% bankrupt. So then you guys, will you be able to do for me Company B, Company C, and then you do the April 2024 question? You guys, will you be able to do? You guys, will you be able to do Company B, Company C? And then you do the April 2024 question. Then if you do that, we have finished the Altman's Z-score. We have finished the Altman's Z-score. So when I come in my class, I will actually not teach you this. I would expect you guys to watch the video and then you make your own notes. When I come in this case here to my next class, I would want to review, see whether you guys have been able to watch a video on Spring-Gate model. After Altman's, the second one is called Spring-Gate. Spring-Gate model. Spring-Gate model. So Spring-Gate model, I'm going to share that video with you right now. Immediately I finish this, I'm sharing the video with you. Everybody, when we meet, then everybody should have watched the video on Spring-Gate. And of course, you must have done, in this case here, the question that is there from the past papers. So that when I come, instead of doing the Spring-Gate, I'll be able to do now, like a review, I'll be able to do the question April 2024. And then from there, I'll be able to jump to the other models like Beavers. We have Beavers. We have Agenti, which is qualitative like that. All right. Then from there, we shall be able to go to what we call unbundling an organization. To bundle is to put together, to unbundle is to split. So we split this company up, like if it's RCM, RCM-ACCA, RCM-CPA, RCM-ATD, different companies, and I want to raise money, then how do we exercise the concept of sell-off, cover-outs, etc. Otherwise, ladies and gentlemen, it has been a nice evening. I believe we shall be able to work very hard. We shall be able to speak one language to the very end. And then, of course, we shall be able to do what you have to overcome. Otherwise, thank you very much. Much love to you guys from this Chief Ninja. We shall overcome, yes. Great. What a session. Great. Thank you very much. No going backwards. No. Thank you so much. We shall overcome. We shall overcome. We shall overcome. And I say bye. And of course, the new students who have been able to attend, welcome you officially to RCM, the School of CPA Ninjas here. Great. So please, karibuni sana. Oh, I show you the speed. Yes, I promised. I promised to show you guys the speed. Yes. Yeah, the LMS. Yeah, I promised to show you the speed. Let me see. Let me see. So then I'll look for a video. Yeah, just how do I work with this speed? Great. It's always good to try to answer all students' questions, YouTube. And then again, ladies and gentlemen, remember now we're going to start remember those extra classes, eh? Remember we have some extra classes. Yeah, so here, please allow me just a minute. I'll show you something very important. All right. So in your video, Yeah, Friday, yeah, we'll discuss about this. Yeah, I can see somebody complaining that they registered last week. I'll be able to sort that out. Don't worry. Let me just get your group. I'll be able to sort that out. Don't worry. You've just started. You've just started. Thank you.